Is title insurance a ripoff? You're often paying $1,000 to $1,500 for this at the time you buy a property. What are you actually paying for? Then, to get a lower mortgage rate, is it worth it for you to pay discount points at the closing table? What about refinancing? How do you figure out whether that's worth it or not? We get into all that and more. It's my conversation with Ridge Lending Group President Caeli Ridge. Is title insurance a ripoff? A few years ago, a lot of people speculated that title insurance would fade away because the property's ownership could be transparent and accessible to everybody on the blockchain. But we don't really see that happening. So tell us about title insurance, and really, are we getting value in what we pay for there at the closing table?
Well, I think the first thing I would say is that it really isn't going to be an option. As far as I know, as long as the individual is going to source institutional funding, leverage, use of other people's money, they're going to require the lender, aka Ridge Lending or whoever you're working with, they're going to require that title insurance that insures their first lien position. Doing that title search, first and foremost, is going to make it clear that there isn't some cloud on title, that there isn't some mechanic lien that had been sitting out there for however many years it may have just been around. And those types of things never go away. So for a lending perspective, it's going to be real important that that title insurance is paid for and in place to protect their interests. Things like judgments, tax liens, like I said, a mechanic's lien, those will automatically take a first lien position in front of a mortgage. So obviously we're not going to risk that and find ourselves in second lien position in the event of default and somebody else is getting paid before we are. So not really an option. Is it a ripoff? You know, I don't know enough about how often it's paid out and not to speak to that, but I will tell you that it isn't a choice.
Title insurance, like Caeli was talking about, it protects against fraud related to the property's ownership, someone else claiming rights to the property, and this title search that an insurer does, it also, it looks for those liens and encumbrances, including unpaid taxes, maybe unpaid HOA dues. But mortgage lenders typically require title insurance. And if you, the borrower, you might think that's annoying. Well, it does make sense because the bank needs to protect their collateral. If a bank ever has to foreclose, they need to have access to you, the borrower, to be able to do that without any liens or ownership claims from somebody else. Caeli, how often do title insurance companies mess up or have to pay out a claim? Does that ever happen?
I don't know that I mean, if I have been involved in circumstances where that was the case, it's been so many years ago, they're pretty fastidious. I don't know that I could recall a circumstance where something had happened and the title insurance was liable. They go through the paces, man. They've got to make sure that, and they're doing deep dives and searches across nationwide to make sure that there isn't any unnecessary issue that's been placed on title. Not that I'm aware of, no.
Are there any of those other items that we tend to see on a good faith estimate that have had any interesting trends or changes to them in the past few years?
Yeah, I've got a good one, and this is actually timely. Credit reports. So over the last couple of years, something has been happening with credit reports where, maybe 3-4 years ago, a credit report, let's say a joint credit report, a husband and wife went and applied, that credit report might cost $25. Well, now it's in excess of 100 plus. When we look at a standard closing disclosure today, credit report costs have increased significantly. I don't have the percentages, but by a large margin over the last couple of years.
All right. Typically not one of your bigger costs, but a little noteworthy there. One thing that people might opt and choose to have on their good faith estimate, so that borrower therefore would actually pay more out of pocket. With today's higher mortgage rates, and I'm sure not to say high because historically they are not high, do we see more people opting to pay down discount points at the closing table to get a lower rate? And talk to us about the trade-offs there.
I would say that right now, first and foremost, that there isn't a lot of option for investment property transactions, whether it be a purchase or a refinance. There's not going to be that option where the consumer gets to choose to say, okay, I want to pay points for a lower rate or not pay points for a higher rate. The not paying points is the key here. There isn't going to be a 0-point option for investment property transactions. When does it make sense to pay additional points, let's say, to reduce an interest rate? The break-even math, and I'm always talking about the math. The break-even math is actually, the formula is very simple. all you need to do is figure out the cost of the points, dollar amount of the points. Let's say it's $1,000, okay? And that's what it's going to cost you to, say, get an eighth or a quarter or whatever the denomination is in the interest rate reduction. But you aren't worried about the interest rate necessarily. You're looking at the monthly payment difference, okay? So if it's going to cost you $1,000 in extra points, but it's only going to save you $30 a month in payment, when you divide those two numbers, what's that going to take you?
33 months.
Well, okay. And does that make sense? Am I going to refinance in 33 months? If the answer is no, then sure, pay the extra $1,000. But that's the math. The cost versus the monthly payment difference, divide that. That gives you the number of months it takes to recapture cost versus cash flow or savings. And then you be the determining factor on when that makes sense.
Yep, that's pretty simple math. Of course, you can
Yeah.
also factor in some inflation over time. And if you would invest that $1,000 in a different vehicle, what pace would that grow at as well? So we've been talking about the pros and cons of buying down your mortgage rate with discount points. Talk about that math and is it worth it to refinance or not? It's a difficult decision for some people to refinance today with higher mortgage rates than we had just a few years ago. And at the same time, we've got a lot of dead equity that's locked up.
Yeah. So I think that it depends on, I would start first by saying, are we looking to harvest equity? Are we pulling cash out, or are we simply doing a rate and term refinance where we're replacing one loan with another loan? If it's for rate and term, if we're simply replacing the loan that we have today with a new loan, that math is going to be pretty simple. Why would you replace a 6% interest rate with a 7% interest rate if all other things were equal? You wouldn't, unless there was a balloon feature or maybe an adjustable rate mortgage or something of that nature involved there that you have to make the refinance. So taking that aside, focusing on a cash out refinance and when does it make sense? So there's a little extra layered math here. The cash that you're harvesting, the equity that you're harvesting, first of all, borrowed funds are non-taxable, okay? What are we going to do with that pile of cash? Are we going to redeploy it for investing? More often than not, talking to investors, the answer is yes. What is that return going to look like? So you've got to factor that in as well. And then we'll get to the tax benefit in a moment. But generally speaking, I like to, as long as the cash flow is still there, okay, you've got to have someone else covering that payment, okay? I don't normally, there's exceptions to every rule, I don't normally advise going negative on a cash out refi. There are exceptions, okay? Please hear me. But otherwise, as long as the existing rents are covering and that thing is still being paid for by somebody else, then what you want to do is look at that monthly payment difference again versus what you're getting out of it, and then you divide those two numbers pretty simply, and it'll take you how long, and then you've got to layer in the cash flow that you're going to get from the new acquisitions, and whether that be real estate or some other type of investment, whatever the return is, you're going to be using that to offset. And then finally, I would say make sure that you're adding in the tax benefit. These are rental properties, guys, right? So closing costs can be deducted. Now, that may end up hurting debt to income ratio down the road, so don't forget, Ridge Lending is going to be looking at your draft tax returns. Very, very important to ensure that we're setting you up for success and optimizing things like debt to income ratio on an annual basis.
Now, some investors or even primary residence owners might look at their first and only mortgage on a property, see that it's 4%, and really not want to touch that. What is the environment and the appetite like today for having a refinance in the form of a second mortgage? That way you can keep your first mortgage in place at, say, 4%, get a second mortgage at 7% or more. How does that look for both owner-occupied and non-owner-occupied properties today?
You're going to be looking at prime plus in many cases. If you don't want to mess with a first lien, a second lien mortgage is typically going to be tied to an index called prime. Those of you that are familiar with this have probably heard of that indice. There's lots of them. The Fed fund rate, by the way, is an index. There's lots of them. The Treasury is also another index. Prime is sitting, I think, at 7.5%. So you're probably going to be looking at rate-wise, depending on occupancy and credit score and all of those LLPAs that we always talk about, loan level price adjustment. You know, it could be prime plus 0, it could be prime plus 4. So interest rates could range between, say, 7.5 on average up to 11, even 12%, depending on those other variables. More often than not, though, those are going to be interest only. Okay, so make sure that you're doing that simple math there. And I would prefer, if I'm giving advice, the second liens, the HE loan, which is closed ended, very much like your first mortgage. It's just in second lien position. It's amortized over a certain period of time, closed ended. Not as big a fan of that. If you can find the second liens, especially for non owner occupied, I would encourage it to be that open ended HELOC type.
What are we looking at for combined loan to value ratios with second mortgages?
You know, on an owner occupied, I think you'd be happy to get 90. I think I've heard that in some cases they can go up to 95%. In my opinion, I
Great.
would go as high as they'll let you go, right? On a non-owner occupied, I think you'd be real lucky to find 80 and probably closer to 70.
That really helps a lot with our planning. You can watch this one next.